In this video, I'll talk about the top 5 safest investments you can make. Number 1, an ETF. An ETF is an exchange-traded fund, essentially a bundle of stocks, sometimes stocks and bonds. In some cases, you can see an ETF holding like 100 stocks or less, sometimes a few hundred, and sometimes as much as 1,000 or more. Now, with an ETF, you have what's called an expense ratio. What is that? So an expense ratio is a fee you pay to the fund to manage it. It's a service because they're rebalancing the stocks within it. Well, fortunately, with an ETF, the expense ratio is very low. It can be about 0.1%, sometimes a little more, sometimes a little less, but I'll give you some nice round numbers here. If you have $100,000 in an ETF, your expense ratio will be $100 a year. So that's not too bad. All right, so ETFs are really in place to help protect your wealth. If you're interested in building your wealth, that's when you should move towards more individual stocks. All right, so that's number 1. Number 2 is very similar to an ETF. It's an index fund. Pretty much the same thing. It can be a bundle of stocks, sometimes stocks and bonds. You can see them having less than 100 stocks, sometimes a few hundred, and sometimes as much as 1,000 or more. Now, very similar to an ETF, the expense ratio is about 0.1%, could be a little less, sometimes a little more. But here's the big difference between ETFs and index funds. So with an ETF, you have what's called intraday pricing. What that means is, here's an example. Let's say you want to go buy an ETF at 2 p.m. on a Tuesday. It's $100 for that ETF. So you go in and you buy it. You get the price or pretty close to. Whereas with an index fund, if you go in at 2 p.m. on a Tuesday, it's $100 for that index fund. You can buy it at 2 p.m., but you don't actually get it at that price. You have to wait to the end of the day, then you get that end of day price. But does it really matter? The answer is no, because you are not trading ETFs and index funds. You're going to pick 1, 2, or 3 and then move forward and then keep buying those every month. So overall, ETFs and index funds are very similar and they have pretty much the same expense ratio. All right, moving on to number 3, that would be a mutual fund. It is similar to index fund, but it has a very high expense ratio. So instead of 0.1%, it can be as high as 2%. So to give you some nice round numbers there, if you have a $100,000 mutual fund, you're going to pay $2,000 a year. Now, I tell people only invest in a mutual fund if you have a personal relationship with a mutual fund manager and they give you the peace of mind, then you're paying a premium for that peace of mind. Otherwise, if you want the same returns for less money out of your pocket, in that case, you can go ahead and invest in an ETF or index fund. So overall, those 3 are very similar, except mutual funds are a bit more expensive. All right, moving on to number 4. In this case, we are moving towards individual stocks, but in this case, you want to look at those on sale stocks in Tykr with a 4M score of 80 or higher. So you might be asking, what in the world is a 4M? All right, let me explain. There are a lot of investors out there, especially in Wall Street, you can find them on Twitter and Reddit and YouTube as well, that they start and they stop with numbers. But investing is more than just numbers. You have to look past the numbers and look at the business. Well, that's where the 4M tool comes into play. Now, this is kind of a philosophy created by Warren Buffett, even his mentor, Ben Graham. Somebody that has really coined the phrase 4M is Phil Town. I have a big respect for all these guys. With the 4Ms, what we've done within Tykr is we've kind of gamified the experience, creating a score of maximum score of 100. So here are the 4Ms. The first M is the margin of safety. That really encompasses the math part of investing. The second M is the meaning. That's the business model. How many different revenue streams does a business have and how scalable are those revenue streams? Scalable means you can increase revenue a lot faster than your payroll. So we like those businesses that have scalable revenue. The third M would be the moat. That's how a business stacks up against other businesses in the same sector or industry. And then that last M, that fourth M, would be the management. That's a track record of the CEO. Now, it can be very hard to do homework on your own to determine what is a good 4M. Fortunately, Tykr does that for you. We actually use OpenAI to help you with that meaning, moat, and management to see what that score is. So to backtrack there, again, you want to look for those on sale stocks with a 4M score that's 80 or higher. Those are really strong, safe businesses, and they can actually perform better, get you better returns than ETFs, index funds, and mutual funds. All right, moving on to number 5, and I don't want to sound cheesy here, but one of the safest investments you can make is yourself. I have a friend of mine who's a professor. He's a PhD. He's been teaching for well over a decade, probably going on a decade and a half, if not longer. But he has stated that the real learning begins after college. Now, there are a lot of people out there when they go through high school or college, they stop learning. They don't have any ambition to learn anymore. What you should be doing, and I know a lot of you are probably there already, but you should be listening to podcasts. You should be reading books. You should be watching YouTube if you really want to get focused and learn something fast. And of course, you should be investing in courses. When you're actively learning ongoing, that's how you really help advance yourself in your career or help build your business or, of course, become a better investor. So investing in yourself is something we should all be doing. And before I wrap up, I do have an honorable mention that did not make the top 5. That would be real estate. Real estate is a very safe play, but keep in mind it does take a bit more homework, a bit more money, and you definitely want a mentor to help you along on that journey because you could make a lot of mistakes. But real estate is something we will need. People keep making more people, which means we need homes. If you're in real estate, that's a good place to be. That is a safe place to be for the long term. All right, if you guys like this video, hit that like button. If you want to see more like it, hit that subscribe button. And if you want to find some great ETFs and even some great stocks, I invite you to join Tykr for free.